Today, I made a decision, one that wasn't driven by emotion or speculation, but by data, history, and a deep understanding of how systems behave when they approach the end of their cycles. I bought more silver. And while that may sound like a simple action, it wasn't, because this wasn't just about the metal, it was about a signal, a shift, a recognition that we're moving deeper into a world where money is being distorted, politics is becoming theater, and trust in institutions and currencies, in leadership, is eroding. The catalyst, a subtle but unmistakable gesture from Trump, not necessarily a policy, not a headline, but a signal that the game is accelerating. The vast majority of people live their lives under systems they don't fully understand. They place their faith in governments, central banks, and economic narratives that have been repeated so often, they become dogma. That systems, like people, operate in cycles. And right now, the monetary system is moving into a late and dangerous phase, one characterized not by discipline, but by desperation. When monetary policy becomes a tool, not of management, but of manipulation, it signals that the system is no longer functioning as intended. Interest rates, which are supposed to reflect the cost of money and the risk of lending, are being distorted deliberately. They are no longer set by markets, but by committees. Central banks have become the largest participants in the very markets they are meant to oversee. This is no longer policy. This is control. The underlying problem is structural. The debt is too high. The productivity growth is too low. The promises made, whether in the form of pensions, entitlements, or interest payments, far exceed the capacity of real economic output to fulfill them. So the response has shifted from reform to illusion. And that illusion is maintained through monetary expansion. By keeping interest rates artificially low and injecting liquidity into the system, central authorities create the appearance of stability, but it's not real. It's borrowed time. When you manipulate the cost of capital, you distort every decision built upon it. Investment becomes speculation. Capital allocation shifts from productive enterprise to financial engineering. Corporations no longer invest in long-term value creation. They buy back their own stock. Governments no longer face consequences for overspending. They issue more debt and have it monetized. The incentives become perverse, and the system moves further from equilibrium. This is not the first time in history this has happened. In every major cycle, from the Roman Empire to the Dutch, British, and now American systems, the story is the same. Excess leads to imbalance. Imbalance leads to intervention. And intervention leads to collapse of trust. Trust is the true currency of any monetary system. Once it begins to erode, the decline accelerates. What we are seeing now is that erosion in real time, when inflation appears, it is no longer viewed as a problem caused by money printing. It is redefined, blamed on supply chains or geopolitical tensions. When asset bubbles form, they are not treated as signs of excess liquidity, but as signs of confidence. Reality is rebranded because the system cannot handle the truth. But markets have a memory, and history has a rhythm. Eventually, the consequences of distortion become too large to ignore. Savers begin to look for alternatives. Investors begin to hedge. Nations begin to de-dollarize. Confidence once lost is difficult to regain. The challenge now is not just economic, it's psychological. A generation has grown up believing that central banks can fix any problem, that interest rates can stay low forever, and that markets always bounce back. They've been conditioned to expect intervention, to depend on it, but dependency is not resilience. It's fragility disguised as prosperity. The longer the manipulation continues, the more severe the eventual correction. It's not a question of if, It's a question of when. And those who understand cycles, who study history, who detach emotion from analysis, they don't wait for headlines. They prepare quietly, intelligently. What does preparation look like? It's not about panic. It's about perspective. It's recognizing that paper claims can be created infinitely, but real assets cannot. It's understanding that wealth is not what a screen tells you. It's what endures when systems fail. It's not about making bets. It's about building bridges to the other side of a transition, because this is what we are in a transition. From trust in fiat systems to a rediscovery of real value, from monetary engineering to monetary reality, and from short-term stimulus to long-term consequences. The manipulation of monetary policy is not just a policy mistake. It is a signal that we have moved past the point where normal tools work. And when normal tools fail, history reminds us the system begins to bend under its own weight, and then it breaks. The question isn't whether the system will be restructured. The question is whether you'll be on the wrong side of it when it is. In an ideal world, markets would be governed by fundamentals, earnings, productivity, interest rates, trade flows. But in the world we live in today, those fundamentals are increasingly secondary. Political signals have overtaken traditional indicators, not because they provide clarity, but because they reveal the fragility of the system beneath them. When the structure of an economy is sound, political noise is just that, noise. But when the foundation begins to crack, every political movement becomes a potential trigger. We are living in an age where politics and economics are no longer separate domains. They are deeply entangled. Policy is not being made in a vacuum. It is being shaped by polarization, populism, and the pressure of unsustainable debt levels. As a result, signals that used to be dismissed as rhetoric are now interpreted as strategic maneuvers. A tweet, a press conference, or even a facial expression from a political leader can move markets more than a quarter-point rate change or an earnings report from a major firm. This is not random. It is the consequence of operating in a system that is reaching its limits. When debt levels are this high and interest rates are already near zero or negative in real terms, there is little room left for traditional monetary policy to maneuver. Fiscal policy steps in, but it is inherently political. What we are watching now is not policy as management. It is policy as reaction. Reaction to inequality, to inflation, to geopolitical shifts, to social unrest. And when policy becomes reactive, politics becomes the driver. Political leaders, whether intentionally or not, are now signaling where the cracks are. When they call for more stimulus, more bailouts, or aggressive rate cuts, they're not expressing strength, they're admitting fragility. When they propose capital controls, trade barriers, or currency manipulation, they reveal that the system they oversee cannot sustain itself without intervention. These signals are important not for what they say explicitly, but for what they imply structurally. The rise of populism is one such signal. It's not a cause, it's a symptom. It reflects the erosion of trust in institutions, the widening of inequality, and the failure of previous policies to create broad-based prosperity. As more people feel left behind by the current system, they vote for change, any change, and that creates volatility. Populist leaders are more willing to defy economic orthodoxy, challenge central banks, and undermine global agreements. These actions send clear messages to markets. The rules are changing, the anchors are shifting, and the old playbook is obsolete. Geopolitical shifts amplify these dynamics. When major powers begin to weaponize trade, threaten sanctions, or challenge the global reserve currency system, They are not just negotiating, they are signaling a new phase in the global order. These are not isolated events. They are pieces of a larger cycle, one in which the dominant power historically overextends itself, becomes financially strained, and begins to lose control over the global narrative. Political signals matter more than ever because they reflect the breakdown of long-term consensus. For decades, there was a general agreement among the major economies about how things should work. Free trade, open capital markets, independent central banks. That consensus has collapsed. What remains is a battlefield of competing interests, short-term thinking, and reactive policymaking. And in that environment, political signals are no longer noise. They are indicators of systemic stress. Understanding this new reality means learning to read politics not as ideology, but as information. Who benefits from certain policies? What vulnerabilities are they exposing? What message is being sent to allies, rivals, and markets? The challenge is that political signals are rarely clear. They are often wrapped in rhetoric and driven by agendas. But the key is not to take them at face value. It's to place them in context. What cycle are we in? What has historically followed similar signals? What is being protected? And what is being sacrificed? Because in times like these, the words of politicians are no longer just commentary. They are clues. And when institutions weaken, when currencies falter, and when the future becomes uncertain, it is not the spreadsheet that will warn you first. It's the signal. Throughout history, the value of things has never been dictated solely by their price. Price is often a reflection of sentiment, of perception, not reality. And there are moments, particularly in late cycle environments like the one we're in now, when price diverges significantly from value. Silver is one of the most mispriced assets in the global financial system today. It is undervalued, underrated, and profoundly underowned, not because it lacks utility or history, but because the system in which it exists is blind to what it represents. Most people think of silver in simplistic terms as a shiny metal, an industrial commodity, or a cheaper cousin to gold. But this view is incomplete. Silver has served as money for thousands of years across every major civilization. It was not chosen arbitrarily. Its scarcity, divisibility, and durability made it a natural store of value long before central banks or financial derivatives ever existed. And yet, in today's financialized economy, silver has been pushed to the margins, ignored by institutions, dismissed by analysts, and excluded from most portfolios. That neglect is a signal. The undervaluation of silver begins with monetary policy. For over a decade, central banks have suppressed interest rates and expanded balance sheets in a coordinated effort to sustain growth. In doing so, they have distorted the pricing of all assets. Capital has flooded into equities, real estate, and speculative tech, anything that promises yield or narrative momentum. But real assets, particularly those that don't produce cash flows, have been left behind. This neglect has created a profound dislocation between what silver is worth and what it's priced at. Underrated, because very few understand its dual role. Silver is both a monetary metal and an industrial metal that makes it unique. It is used in everything from solar panels and electric vehicles to semiconductors and medical instruments. As the world transitions toward electrification, decarbonization, and digitization, the demand for silver is structurally rising, and yet its price behavior reflects none of this. Markets are treating silver as if it belongs to the past, when in reality it is embedded in the technologies of the future. But perhaps most importantly, silver is underowned. Institutional allocation to precious metals, and silver in particular, is minuscule. pension funds, sovereign wealth funds, endowments. These entities are massively overweight paper assets and underweight tangible stores of value. The global silver market is small, so small, in fact, that a minor reallocation from paper wealth into silver would cause a disproportionate price revaluation. This is not theoretical. It has happened before during times of crisis or structural transition. Capital seeks safety, and safety historically has often meant hard assets. The question then becomes, why is silver still so cheap? The answer lies in the structure of the market. The silver price is largely set by paper contracts traded on exchanges, not by the physical metal itself. This allows large players to suppress volatility, manage perception, and disconnect price from supply-demand fundamentals. But this is a temporary illusion. It can be maintained until it can't. When demand for physical delivery exceeds supply, when trust in the paper system breaks down, and when the leverage unwinds, the revaluation will not be gradual. It will be violent. That is the opportunity and the warning, because owning silver today is not just a financial decision, it is a strategic one. It is a hedge against currency debasement, a vote against distorted markets, and a form of optionality in a world increasingly defined by fragility. It is a recognition that what is ignored today may become essential tomorrow. And the irony is, the system itself is sending the signals. Central banks are buying gold. Nations are repatriating reserves. Geopolitical tensions are rising. Trust in fiat currencies is weakening. Every one of these developments points toward the need for real, non-digital, non-counterparty dependent assets. Silver fits that requirement, but it remains misunderstood precisely because the system that undervalues it is built on short-term thinking, narrative-driven investment, and an overconfidence in human control over complex dynamics. So while most remain distracted by the noise, those who study the cycles, those who understand history, those who see beyond the surface, they quietly accumulate what the future will require. Silver is not a relic, it is a reserve. It is not just cheap, it is mispriced, not just underappreciated, but strategically essential. And in a world moving toward monetary transition, technological transformation, and political fragmentation, that mispricing is not likely to last. It is only a matter of time before perception catches up with reality. Every economy, every empire, and every financial system moves through cycles. These cycles are as old as civilization itself. They begin in strength, build through productivity, expand through debt, and end in imbalance. What we're seeing now in clear and unmistakable terms are the signals that we're late in the current cycle, not just in markets, but in the structure of the global order itself. The markers are everywhere for those who choose to look beyond surface-level optimism. Debt levels are reaching historical extremes, not just private debt, but sovereign debt, the kind that can't be defaulted on without unraveling trust in the entire system. Governments around the world are spending far more than they take in. Their deficits are no longer counter-cyclical tools for temporary stimulus. They've become permanent features of fiscal policy, sustained not by revenue, but by borrowing. This would be manageable if the borrowing were productive, but increasingly it isn't. The returns on new debt, in terms of GDP growth or increased productivity, are diminishing. The marginal efficiency of capital has declined. Money is being spent to patch holes, not to build capacity. And because interest rates have been pushed artificially low, there's little immediate consequence. But the consequence is not eliminated, it is deferred and made larger with time. Late cycle economies are defined by this sort of imbalance. Growth is no longer organic, it's engineered. Asset prices are propped up, not by fundamentals, but by liquidity injections. Central banks have become the main drivers of financial markets, not neutral observers. The very tools meant to stabilize the system, rate cuts, quantitative easing, forward guidance, have become crutches. And every time the economy falters, those crutches are used more aggressively, but with each use, they lose their power. What comes with this is a change in behavior, not just from policymakers, but from the participants in the system. Corporations focus less on investment and innovation and more on financial engineering. Households, squeezed by the rising cost of living and declining purchasing power, turn to credit just to maintain their standard of living. Speculation replaces savings. Short-term thinking replaces long-term strategy. At this point in the cycle, inequality tends to widen. Those who own assets, real estate, equities, collectibles, see their wealth grow disproportionately because the system favors asset inflation. Meanwhile, those who depend on wages find themselves falling behind. This imbalance isn't just economic, it becomes social and political. Discontent rises. Trust in institutions erodes. Populism emerges not as a fringe phenomenon, but as a mainstream force. The late cycle is also marked by a loss of monetary credibility. When inflation begins to appear, it's first denied, then it's explained away, then it's blamed on external factors, supply chains, foreign wars, natural disasters, but rarely is the root cause acknowledged. Too much money chasing too few goods, driven by years of easy credit and fiscal excess. And when policymakers are finally forced to respond, they do so with hesitation, fearing that even modest tightening will trigger a cascade of defaults, bankruptcies, and recession. This is the dilemma of the late cycle. The tools that once worked now threaten to break the very system they were designed to support. And so intervention continues, but with diminishing returns and growing side effects. Eventually, the system reaches a tipping point. That point is not necessarily a crash. More often, it's a slow and grinding loss of confidence. People stop believing in the currency. They question the reliability of government promises. They seek alternatives, not because they want to, but because they have to. This is how transitions begin. The path forward is not one of fear, but of awareness. Understanding the cycle means understanding where we are and what typically follows. It means recognizing that late cycle behavior is unsustainable and that preservation of wealth and stability requires shifting strategies. Real assets begin to outperform. Traditional portfolios designed for stability in mid-cycle environments start to underperform. The winners are not those who take on more risk, but those who manage it more intelligently. And in times like these, it's not about predicting exact dates or moments. It's about observing patterns, seeing relationships, and acknowledging reality as it is, not as we wish it to be. We are not at the beginning of something. We are near the end of a long cycle, and the end of a cycle is not the end of the world, but it is the end of the assumptions that built it. Most people fixate on individuals. They search for leaders to praise or blame, hoping that outcomes are the result of singular actions or decisions. But the truth is far more structural, far more systemic. What's unfolding now, whether through political figures, market signals, or asset movements like silver, is not about a person or a metal. It's about a system that's losing its credibility. And when systems lose credibility, the consequences go far beyond elections, policy debates, or short-term price movements. They affect everything. Credibility is the foundation of any functioning order, economic, political, or social. It's the belief that promises will be honored, that money will retain value, that rules will be enforced fairly. Once that belief erodes, Everything built upon it becomes unstable. The structures may remain in place for a while, but their integrity is compromised. They begin to rot from within. The monetary system is a perfect example. For decades, the global economy has operated on a fiat-based framework. Currencies backed not by gold, silver, or any real asset, but by trust. Trust in central banks, trust in governments, trust that those in charge would act prudently, that they would manage inflation, maintain financial stability, and honor the implicit social contracts. But that trust is no longer earned. It is being stretched thin, repackaged, and in many cases abused. Consider the role of central banks over the past 15 years. When the system nearly collapsed in 2008, emergency measures were taken, interest rates cut to zero, balance sheets expanded. These actions were necessary in the moment, but they never stopped. Each subsequent crisis, each market wobble, brought more intervention. Liquidity injections became the default response to every problem. Over time, markets adapted. They stopped functioning on fundamentals and began functioning on central bank cues. This isn't stability, it's dependence. The political system has followed a similar trajectory. As inequality widened and social trust weakened, leaders on all sides began operating more like performers than stewards. Signals are sent not to unify or inform, but to trigger and divide. The emphasis shifted from governing institutions to shaping perception. In that environment, figures like Trump are not anomalies. They are products of a system that no longer reflects the values it once claimed to uphold. But again, this is not about Trump. It's not about whether one supports or opposes him. It's about what his rise and the reactions to it signify. It is a symptom of institutional failure, a sign that large segments of the population no longer believe the narratives they're being told. They no longer believe the numbers